Advanced Financial Accounting. In this presentation, we're going to work a consolidation practice problem. That consolidation having a parent-subsidiary relationship, taking two trial balances, putting them together with a consolidation worksheet. There will be downstream and upstream transactions, which is where the focus will be, and we'll be using a modified equity method. A modified equity method as opposed to a fully adjusted equity method. Get ready to account with Advanced Financial Accounting. Here we have the information for our practice problem. Let's review this first. We have P purchased a percent of S. P is the parent. S is going to be the subsidiary. Common stock on January 1st, 2020. So that's going to be the year of the year of the purchase, not the year of the consolidation. The consolidation is going to be taking place in 2000x3. So then we have the percentage of stock that was purchased, 80%, which of course is a controlling interest, but it also means there's a 20% non-controlling interest. The amount was for $312,960. The non-controlling interest fair value at the point of purchase, $78,240. The net assets of S at the point of purchase, in other words, assets minus liabilities or equity section as of the point of purchase, $341,200. We're going to consolidate for December 2000x3. So x0, so we got this full year because January, it was at January. So x0, 1, 2, and 3. That's going to be 4 years later on the consolidation, December 31st, 2000x3 from the point in time of purchase. Book value and fair value are the same except for equipment. So the equipment is going to be different. We're going to kind of back into the value of the equipment. There's not going to be any goodwill. So given there's no goodwill, it'll help us to back into the equipment difference in fair value and book value. And then the accumulated depreciation of S at the purchase date was $39,000. We have two, and then here's kind of like the new information that we're focusing in on here. These are going to be the intercompany kind of transactions where we have either P selling to S, S selling to P. And now we're going to be thinking about this and thinking about P recording their books on an equity method, but not the fully adjusted equity method. That's going to be what the difference is a bit. And also note, we're going to be using a similar worksheet, however. And remember, this can be a little bit tedious, but if you think about it, there's really 4 components we're kind of looking at. We're looking at, we could have P selling to S, S selling to P. If P sells to S, we're going to name that a downstream transaction. If S sells to P, subsidiary to parent, that's going to be an upstream type of transaction. So there's two kind of ways this transaction can go. And then we're typically going to have to consider transactions that happened last year as they will impact the current year due to the fact that there's still going to be an amount in ending inventory. And then we're going to have to deal with the amounts in the current year. So there's going to be P to S, S to P prior year, P to S, S to P in the current year. So once we have that grouped together, we could start thinking about how can we set up a standardized kind of system for us to put this information in place. All right. So then we have 2000x2 S sold inventory to P. So this happened last year, 2000x2 S sold to P. So S is the subsidiary selling up. So it's an up transaction to P. We have the cost and the sales price. Then it says that P resold in 2000x2 60% of it. So now they're giving us the amount that was resold. Remember here, they could give us the amount that was still in ending inventory, or the amount that was resold, or a percent that's still in ending inventory, or the percent that's resold, and we should be able to figure out what we need to work the problem. Then we have in 2000x2 P sold inventory to S, so prior year transaction now happened in the prior year. P sold to S, downstream transaction. This is the amount, and then they're saying that 66.66 or 2/3 is going to be left on S's books, which is what we're concerned about given the fact that we need to do the consolidation in the current year, 2000x3. Then we have the current year transactions between S and P. 2000x3, S sold inventory to P, and so that means we're going S to P upstream transaction in the current year, x3 that we will be consolidating, and at the end of the year, the current year we will be consolidating, P resold in 2000x3. So this is the amount that they resold. So this was the amount that they resold up here, not the amount that's remaining in ending inventory. They're giving us the amount that was resold, the 33.33 or 1/3 of it. Then in the current year, we have P sold to S, finally, the last component. The P to S downstream transaction current year, this amount. None was resold, so it's still on the books in ending inventory. Also, we have intercompany transaction of accounts receivable and payable, meaning some of these transactions happened on account, meaning S owes P the 10,000. So we're going to have to reverse the payable and the receivable of that 10,000. A modified equity method is going to be used here. So we're going to be using a modified equity method, meaning in essence, they're going to be using kind of like the equity method, but not accounting for all these reversing transactions within the equity method. So we're going to think about what the equity method will be doing then, and then use our similar system to reverse what's going to happen in the consolidation process. Okay, so first thing we're going to do is concentrate on these new things that happened here, and that's going to be these intercompany transactions. Now, this time we want to look at this in terms of prior year transactions, current year transactions, and in terms of downstream transactions and upstream transactions. So, for example, here we have 2000x2 downstream transaction from P to S, and we're going to have the three components here in orange. Then we're going to go back up here in a second. Then we'll consider 2000x3 downstream transactions. So these are still downstream, now current year downstream transactions. Those are the three yellow components. Now we're in 2000x2 prior year transactions, upstream transactions in the prior year, three components to that, and those are in green. And then we've got the current year upstream transactions, 2000x3, three components to that. So let's just go through this real quick and we'll say, okay, how are we going to figure this out? We're going to put these together, taking this information from our table. So I'm just going to say, all right, we got the 2000x2 downstream transactions. We said in our data, it said that we had then the 2000x2 P sold inventory to S. That's a downstream because it went from parent to subsidiary for the 36. So there's the 36, the 27, the difference between those two being, of course, the 9. And then if we pull out the trusty calculator, we'd say, all right, well then the gross profit percent, 9,000 divided by the 36,000, that's going to be the 25%. The 75 being the cost of good percent or ratio to sales, which could be useful. 27,000 divided by 36,000 is going to give us that 75%. So then they said they resold 66%. So, or 2/3 of it. So it's going to be a rounding kind of issue that we have here. So we're going to say, all right, so of this 36,000, if I take the sales side times 0.67 is 24, about 24,000. If I take the 2/3 to make it a little bit more exact, we got this times 2 divided by 3, and that would give us the 24,000, right? And then the cost of goods sold, same thing. We've got the 27,000 times 2 divided by 3, and that's going to give us the 18, and so on. And then if I subtract these out, we're going to get the 6. You can also get that 18 by taking, say, the 24,000 times the cost of goods sold percent, the 0.75, and that'll give you the 18. And then, we can work these multiple ways, however you want to see it. So then we're going to go down and subtract these out. One way we could think about, okay, what's left in ending inventory? Well, I can say, all right, then if this is the sale that happened, this is the amount that was resold last year. This is what's in ending inventory or beginning inventory now in the current year that we're going to be working in on. So then that's going to be the 36,000 minus the 12,000, or I'm sorry, let me do that again. 36,000 minus the 24,000. That's going to give us the 12,000. And then so on, the 27 minus the 18 would give us the 9. And then again, we could subtract those out. We can also get the 9 by taking the 12,000 by the times the 25% and so on. So then let's go on down to the next one. We've got the 2000x3 downstream. So we're still talking downstream, meaning we're talking from P to S. Sales happen from P to S, but this time we're talking the current year. So now current year transactions. So our data said that P sold to S 22,000. So 22,000 here. Cost of goods sold was the 16,500, the difference being 5,500. The amount that was resold, none was resold. Therefore, nothing happens here. So these numbers are just going to flow down. It's going to be reflected in the ending inventory and that's going to be our 3 amounts there. Then we're going to go to the 2000 X2 prior year upstream transactions. So now we're thinking about upstream transactions prior year, meaning from S to P. And our data said that prior year upstream transactions, S sold inventory to P of 60,000, cost of goods sold 36,000. So that's going to be 60,000, the 39, not 36, 39,000. And that difference is the 21. 21,000 divided by 60,000 is 35,000. 39,000 divided by 60,000 is that 65,000. Then if we were to say, all right, 60% of that was resold. So they gave us the amount that's resold. So 60,000 times 0.6 is 36,000. If I took that 36,000 times the 65% cost of goods sold percent times 0.65, we get the 23.4, or we can take as well the 39,000 times the 0.6 here and get the same 23. We could subtract those out, or we can use the gross profit percent here to get the 12.6. Then if I subtract out the 60,000 minus the 36, we get the 24. Once we have that 24, we can then take that and multiply it times the 65% to get the 15.6, or subtract the 39 and the 23.4 to get the 15.6, and so on. We could subtract the 24th and the 15.6 to get the 8,004. Okay, and then we're going to do the same process for 2000 X3 upstream transactions, meaning sales that happen from S to P, which our data says that we had 42,000, cost of goods sold 27.3. Difference being the 14.7. 14.7 divided by 42,000 is 35%. 27,003 divided by 42,000 is 65%. They resold 1/3 or 33.33. I'm going to use 1/3 to be more exact here. So I'm going to say we resold 1/3 of it. So 42,000, times 1 divided by 3 is going to be our 14. And then once we have the 14, we can multiply that times the 65%, 0.65, to get the 9,001. Or we could take that 27,300 times 1 divided by 3 times 1/3 to get the 9,001. 14 minus the 9,001 is the 49. Then down here, the sales, the 42,000 minus the 14 gives us the 28,000. The 27.3 minus the 9,006 or 9,001 gives us the 18.2. Or we can take the 28,000 times the 65% and so on and so forth. All right. So now that we have that information broken out, we can take this information and remember, you just basically, it looks tedious, a long kind of process, but we're taking, downstream transactions prior year, current year, upstream transactions prior year, current year. Then we're going to put them into our little worksheet table. And you can think of this kind of like a worksheet table that you would do for like a statement of cash flows. We just want to standardize our worksheet. So we can almost do this rogue, like just rote without really knowing what's going on. Just put it in there and then be able to go back and say, why does this worksheet work, the way it does, right? So our standard worksheet's going to say, here's going to be my non-controlling interest, my controlling interest, P, and then the total. So I'm going to take that and then I'm going to be breaking it out between the non-controlling and controlling. I'm going to have these standard categories, reverse gross profit and reverse gross profit. These are basically prior year transactions, and then the gross profit deferral, current year transactions. These will typically be positive. These will be negative. It's going to be our scenario. We're going to do that for the net income and then adjust it. We're going to do that for the book, the net assets, and then make the same adjustments to get down here. This will basically be adjusting our first consolidation entry. So this is going to be the basis on which we will be building our journal entries. So to do this, we're going to say then I'm concentrating down here on this 60,000. So we're looking at S down here because S had net income of 60,000, which is sales minus the cost of goods sold. That's usually our starting point for the first journal entry. So I'm going to take that 60,000. We're going to break that out between, I think it was an 80-20 between the controlling and non-controlling interest. So 60,000 times 0.8 is going to be the 48. And then we're going to take the 60,000 times 0.2 non-controlling interest. That's going to be the first half of it. Second half of it's going to be the balance sheet side of things, which are assets minus liabilities. This is the point. This is as of the current year that we are consolidating, not the point that they actually made the purchase. So these are the P and S books for the current year that we're going to consolidate and then do these, ignore these last two columns for now. We're looking at S's books for the current year we'll be consolidating. So I'm just going to take the assets minus the liabilities, 75,000 plus the 45,000 plus the 130,000 plus the 600,000 minus the 119,000 minus the 35,200 minus the 300,000 minus the 46. And that is going to give us the 391,200, which I'm going to break out between the 80/20 times 0.8, and that's going to be the 312,960. If I took that 391,200 times 0.2, that's going to give us the 78,240. Now also note, of course, this is going to be, I can take all the blue numbers and I would come up to the same 391,200, which of course, let's just do that real quick because it'll be fun. 120,000 plus 18,000 plus 438,200 minus the 45,000. And then all of these are combined in net income. So this minus this is that 60,000. So I'm just going to say plus 60,000. Something happened. Let me do it one more time. 120,000 plus 18,000 plus 238,200 minus 45,000 plus 60,000. So there's the 391,200. So that's going to be our starting point for our worksheet. So now that we have that information, we're going to go on down and we're going to populate the meat or the body of this worksheet. So now we've got the non-controlling interest. So this is the net income first half of it. So we have our 60,000. That's going to be from S's net income that we're starting with, that now we're going to be adjusting and breaking out. So let's just go through. This is our colorful sheet that we put together. We're going to then be taking this information from our sheet. So the first items, the 2000 X2 downstream transactions. So this is the 2000 X2. So we're going from here, reverse gross profit down, and we're looking at the prior year transaction, downstream transaction, meaning it's going downstream, meaning it's going from P to S. So, and we're taking the bottom line number, basically the difference here, and that's going to be the 3,000. I would start putting that in the total. So I'm going to start it in the total. And then for downstream transactions, we're just going to include them in column P. We're not going to be breaking it out 80/20 between P and the non-controlling interest. We're just going to put it all into P. And then we have to reverse the gross profit up. So reverse gross profit up. Notice I'm not going to go to the second one here because here we organized it by down to that prior year, the down for the current year, and then up for the prior year, up for the current year. What we're doing here is we're looking at the gross profit deferral down and then up the two prior years and then the two current years. So I'm going to be jumping over here then to the up for the prior year. So that's going to be in the green items, and we're looking for that 8,400. So the 8,400 up for the prior year is going to go here in our worksheet. And then this one, for the up transactions, we will be breaking out between the 80/20 split. So I'm going to take that 8,400, so the 8,400 times 0.8. That's going to give us that 6,720. We're going to take that 8,400 times 0.2, which is going to give us that 1,680. So we break that out between the two. Then we're going to go to the current year transactions. So again, this is broken out two prior years transactions down and up. Then the current year transactions that are going to be down and up. The current year transactions we're going to put in as negatives, and we're going to be subtracting them out in our problem. So we're going to say current year transaction. We're looking at the 2000 X3 down transaction, down transaction, down transaction. Again, we're looking at the last item, which is going to be the 5,500 in our worksheet. So I put that in the total first. And then again, because it's the down transaction, we're only going to be putting that in column P, not breaking it out 80/20. Then we've got the gross profit deferral up. That's going to be over here, gross profit deferral up for the current year. Again, we're looking at the last item that we did. So that's going to be the 9,800. We're going to put it in here. I'm going to put it in as a negative, and then we will be breaking that out between the 80/20 split, 9,800 times 0.8 being that 7,840 and the 9,800 times 0.2 being the 1960. So that's going to be the standard process. So we want to just think about the standard kind of table. Once we have the standard table broken out, we can then just sum it up, of course. So now this would be the net income from S that we're now adjusting. So we're going to say, all right, here's the 60 plus the 3,000 plus the 8,400 minus the 5,500 minus the 9,800. That's going to be the 56. So this is going to be our adjusted. This will be the adjustment that we would have that we're going to use in our first journal entry. So again, we would have broken it out 80%, 48,000, but now we're going to adjust it according to our little table here, plus the 3,000, plus the 6,720, minus the 5,500, minus the 7,840, and that's going to give us the 44,380, same thing for the non-controlling interest. Now, once we have this item set up for the net income, we're simply going to go to the second half of the table. So here's the first half of the table again. If we construct the second half of the table, which started with the net assets, which was assets minus liabilities in the current period or all of equity, the net assets of S, the 391.2, which we usually break out in our first journal entry, 80-20, which we have broken out between 80-20 here. That's going to be our starting point, and then you could see this is kind of a journal entry format. We're just taking the meat of this, taking all of this, and we're just recording that then down here. We're just filling that back in down here. So this is now including, not up there, but down here, the same information. So the second half of the table is easy to populate. We're just going to populate it with the same information, and then we're going to say, all right, well, here's the net assets before 391.2, and then we're going to say plus 3,000 plus the 8,400 minus 5,500 minus the 9,800. There we have that, and so on and so forth. The breakout then for P was the 312,960 plus the 3,000 change, 6,720 minus 5,500 minus the 7,840, and that's going to be the 309,340. So once we have that, then we're going to now go down and think about the Goodwill calculation. Now this one, they gave us a little bit of a twist to get to this Goodwill calculation. So, we got to back into, instead of calculating Goodwill, we got to back into the fair value difference. So let's just consider that. I would think about this just like the cost of goods sold kind of calculation. Like, in other words, I wouldn't try to figure out when you're remembering cost of goods sold and a problem could ask you to calculate cost of goods sold. It could ask you to calculate the beginning inventory, or, the inventory, ending inventory, whatever. What you want to do then is not memorize 5 different formulas, but just one formula, and then obviously use algebra. So I would memorize a formula that looks something like this, plug in the numbers, and then use algebra to figure the difference out. So we got then, that means that the net assets of S were the 341. So the 341 net assets, this is at the point of time that the consolidation took place, like 4 years ago, was it? And then we had the difference was the 50. That's the unknown. So I'm going to make that yellow. That's what they didn't give us. They said, hey, this number is the difference, and that's the unknown. They said Goodwill is 0, so we know what the bottom line number is. So if I didn't know this number, I know this plus this is going to be, the fair value, the 391,200. Then the non-controlling interest they gave us, so that's the non-controlling interest. And then normally what we would do, the non-controlling interest we would have here, if we would subtract these two, we would get then basically what we would think would be the controlling interest, compare that to the amount that was paid, which was the 312,950, and that would give us the Goodwill. Now, in this case, they gave us the Goodwill, right? So this was the unknown. The Goodwill is the unknown. So if we were to basically put a 0 up top, if I did this whole calculation with a 0 up here, I would get to 50,000 down here, which is, so what I would need then to be in balance, if I do my algebra, then of course is this would need to be 50,000 in order for this to be 0. So same kind of calculation. It would just be, we just got to kind of back into it. So I would just still fill out your same formula. Just remember this formula, and then fill out the unknown that you have here, and then back into what you don't know, and that's going to be the 50,000 in this case. Okay. Now we want to think about the modified equity method. So if we were using the full adjusted equity method, what it would be doing is taking into account all of the changes for the intercompany sales that took place. So, but we're going to use the modified adjusted equity method, which is going to be kind of similar to the normal equity method that we would be considering. Okay, so let's take a look. What would be with the equity method normally that you're going to be looking at? Well, we would take the net income. The net income is 60,000 down here, so we would take the 60,000 times the 80%. That would be the 48,000, increasing the investment in S and income for the 48,000. And what we're doing here is, of course, basically reconstructing this number and reconstructing this number. These two numbers need to be eliminated in the consolidation process. So if we can basically see how they were put together, that'll help us if we have problems, eliminating them. And then what'll happen is then we'll have the dividends, which are the 45,000 that went from S out, 80% going to P because they have 80% interest, so 45,000 times 0.8. That's going to be the 36,000 cash going up on P side, and the investment, the 36,000. Okay, and then we had the income from, and then we're going to have the adjustment that we're going to have to make for the income, not for the intercompany. We're not making an adjustment for the intercompany. We're making an adjustment for the depreciation, the change in the depreciation. So this 50,000 was a depreciable asset. So that means, and we're going to say it was a 10-year life depreciable asset. So we're going to say, all right, then we also had this 50,000 divided by 10, which would be a 5,000 adjustment times 80% our interest, 4,000. So there's the 4,000 here. So that means that if I was going to look at the effect on the income down here, let's see if I did that down here. I did not. Let's go ahead and do it right here. I'm going to say the income from S is going to be 48,000 plus the income from S, or minus, let's say, 4,000. That's going to be the 44. So we basically got to that number. So okay, I see how they constructed that number. Now, if we do the same thing for the investment, we're not going to get to this number because this is a balance sheet permanent account, but we can see what happened in the current year, and that'll help us with our consolidation entry. Okay, so now that we have this, let's start to put together our consolidation worksheet. So we've got P, we've got S, we total them up. So this is going to be the total of P and S. That's our starting point. And then we're going to enter our consolidation entries that we'll be using. Now I'm gonna deviate a little bit from our worksheet before, just to kind of show what we did before in terms of a journal entry, and then the adjustment that we're going to make in accordance with our worksheet this time. So normally our consolidation entry would just be, we'd say, all right, well, I know that I'm going to be debiting the investment account. I'm going to put something here so we can see this one thing at a time here. So we have the investment that's going to take place. That's going to be this account. Now, I'm not going to talk about the number yet. We'll come back to the number in a second, but I know that's going to be something that's affected. I know the common stock will be affected in a similar fashion. Same, I'm just going to do this first journal entry like we normally would, just normal kind of thing here. We're going to say, all right, that 120,000 is a credit here for S. We're going to debit it. If I post that, then here's P's, here's S, here's the total. We removed S's portion back to basically P's portion. That's going to be the transaction there. Then we're going to have the additional paid in capital in this case for S that also needs to be removed. It's a credit here. We will then debit it. So if we have P, then S, there's the total. We removed S, we're back to P, which is 0. Then we're going to have the retained earnings at the 238.2. It's a credit here, therefore we will debit it. So here's P's, here's S, here's the total. We then removed the S here, bringing us back to P. Then we're going to be thinking about the dividends declared. So the dividends, so here's the dividends, 45,000. It's a debit here, so we're going to credit it to make it go away. Here's P's, here's S, here's the total. We removed S's to bring us back to P. Then we're going to have the income from S. So that's going to be down here, income from S, which using the equity method is calculated based on this 60,000. So we're going to take this 60,000 here times 0.8, 80%, 48,000. Not exactly what's in here because there's that adjustment that needs to be taken into place that's not on S's books for the the depreciation, which we'll deal with later. But note what's not included in here. We didn't do the fully equity method. It's not including those intercompany sales that are taking place. So so we're going to put the 48 here. If we record that, now we got the 44, 44, 48. This needs to go down to 0 at the end of the day. It's at 4,000 now. That's going to be where we're at this point. And then the non-controlling interest in the income, we're going to say, all right, the normal thing we would do. And also note that this 48,000 ties out to our worksheet here. So we're taking this 48,000, whereas you could use the worksheet number, which would be taking, the bottom line number here. I'm gonna use this number, and then we'll adjust it. Okay, and then we got the non-controlling interest, which would be the 60,000 times 0.2, which would be the 12,000. That's what we would normally do. And then we've got the non-controlling interest in the net assets, which is going to be the net assets. If we think about the net assets, we'd say, all right, that's going to be the 75,000 plus the 45,000 plus the 130,000 plus the 600,000 minus the 35,200 minus 300,000 minus the 46, and that's going to give us the 5. Oh, let me do that one more time. That's going to be the 75,000 plus the 45,000 plus the 130,000 plus the 600,000 minus the 119,000 minus the 35,200 minus the 300 minus the 46. That gives us the 391,200, which you can see in our worksheet here. If I took that and say multiply it times the non-controlling interest, which is 20%, that times the 20%, that's going to give us 20% times the 391,200 is going to give us that 78,240, and then the other side of it being up here in the investment account. So if I took that same amount, the net assets, I won't add them up again for them, but 391,200 times the controlling interest times 0.8, that's going to be our 312,960. So now let's go through this and say, okay, so now this is our normal kind of journal entry. How would we adjust that to get it to adjust it to our table here with the modified equity method being used? Well, what we're going to do is adjust the amount for the non-controlling interest in the net assets and the net income based on this column here. We're not adjusting the P's column. Why? Because P didn't include these items, these intercompany transactions. So we're going to be adjusting it now for the non-controlling interest here on this side. So we're going to say, all right, this 12,000, we're going to adjust it. I'm going to adjust it by the 280 to get it to that 11,720. So I'm going to say, all right, the 12,000 minus the 11,720 would be the 280. So we have a 12,000. This is a debit here, so we're going to credit that by the 280, and then the non-controlling interest here, 78,240. We want it to be 77,960. So I'm just going to say, all right, well then there's 78,240 minus the 77,960, and there's the 280. So if you do it in this kind of two-step process, you can kind of think about this normal journal entry the way you would normally do it, and then look at your table that you made and make your adjustments to that, and that might be just another way you can break this down and think about it. So then we're going to say the second journal entry that we're going to be taking, and obviously then we posted all these here. So this column is the effect of what has happened thus far. This account and this account need to be basically 0 at the end of the day. We basically looked at the equity, the equity type of accounts that we're going to have to be dealing with. All right, so then let's go to the second part. And so this is the prior entry. Now we're going to have the next entry that we're focusing in on, the depreciation entry. Straightforward entry. We've seen this in the past. That being that we had to increase 50,000. We're going to increase, we haven't entered that entry yet, but we're going to increase the asset by 50,000, and we're going to have to calculate the current year depreciation on it as well. So this 5,000 represents the current year depreciation, which is going to be this 50,000 divided by 10 useful life years, 5,000. So there's the depreciation we're going to have to deal with. And we're going to break that depreciation out between the income from S, between like the income accounts, between the controlling and non-controlling interest, meaning income from S, because it's reflected in this number using the equity method, and then the non-controlling interest, so 80-20 split. So we're going to take that 5,000 times 0.8, and that's going to be the 4,000, and then we will take that 5,000 times 0.2, and that will be the 1,000, the 80-20 split, and then we'll obviously record that out. So that's being reflected over here, depreciation being recorded, the income from S being adjusted. Now we've zeroed that out, that now being at 0, so that's good. This one still needs some adjustments to it, and then the non-controlling interest and the income statement having been adjustment for that transaction. Next one. These are the transactions we've done thus far. Here's the one we're concentrating in on now. This one has to do with us putting the property, plant, and equipment on the books from the calculation based on the Goodwill calculation. So you'll recall that we had a 50,000 increase from the fair value to the book value, like 3 years ago in 2000 X0 at the point in time that the purchase took place, and we're gonna have to add that as if kind of it was a sale transaction basically. So we're gonna say, all right, now the machinery and equipment's gonna go on the books. We're gonna increase the value, the machinery and equipment here, depreciable assets in essence. And then we're also going to record, I'm going to record in this journal entry, the accumulated depreciation, not just for the current year, but for the entire time period up until this point, which I think was 4 years, X0, 1, 2, 3, 4 years. So we're going to say, let's say it was the 50,000 divided by 10-year useful life would be 5,000 times, it's been 4 years, 2000 X0, 1, 2, and 3, right? So 4 years times 4, there's the 20,000. So the accumulated depreciation's got to go up not just by the current year, but by 4 years since the point in time that the purchase took place. So then we have the 50,000 minus the 20,000, 50,000 minus the 20,000. These are balance sheet side accounts, and we're going to allocate this adjustment then to the balance sheet accounts related to the controlling and non-controlling interest, those being the investment account here and the non-controlling interest in the net assets, as opposed to the income statement accounts, the income from S and the non-controlling interest in the net income. So I'm going to take that 30,000 times, the 80-20 split times 0.8. That's going to be the 24,000. If I took the 30 times 0.2, that would be the 6,000. That'll put us in balance. Recording this out then, the machinery is going up by that 50,000. So there's the 50,000 there. The accumulated depreciation, 20,000. The investment in S now at 0. So that's good news. That's exciting. And then the non-controlling interest is going to be the other side of things here happening down here. All right, next transaction. This is what we've done thus far, and this is going to be the current thing we're focusing in on. We also know that there's going to be an intercompany receivable and payable. So you notice when we think about these transactions where they're selling inventory, P sells to S and S sells to P, it could have been a cash sale or it could have been on account, So you might be thinking, why aren't we dealing with accounts receivable in that process? Well, we can kind of think of accounts receivable separately, because I should be able to look at accounts receivable, and let's say that if S owes P, we should be able to look at the accounts receivable sub-account, breaking out the receivable by customer, and we should be able to then see the amount that is owed to P by S. We should be able to see that there. And then if we look at the sub-account for S in the accounts payable, we should see the same amount for what is owed to P in the vendor list, in the sub-ledger for the vendor list. So that's where we would probably be picking up the payable and receivables that would be owed. And then if we look those up and say, okay, S owes P 10,000, we see that included in the receivables for P and the payables for S, then we can simply reverse those just like we've seen in prior presentations. This could have happened from current year transactions or prior year transactions, so in any case. So then that means we're going to debit the accounts payable to lower it. So it has a credit balance. We will debit it to make it go down. We're going to credit the accounts receivable to lower it. It has a debit balance. We're going to credit it to make it go down. Then we also said that there was depreciation. This is something we've seen in the past too, so nothing new here if you've been looking at this. So we had depreciation at the point of purchase, 2000x0, 4 years ago, of the 39,000 here. And we want to group that together as if a purchase took place. So in other words, this accumulated depreciation for S 4 years ago, x0, was that 39,000. We want to get rid of the accumulated depreciation that was in place at that time, net it out against the machinery and equipment as if basically a purchase took place. So we're going to increase, or we're going to decrease or debit the accumulated depreciation and decrease the machinery and equipment for the amount of accumulated depreciation on S's book at the point in time of purchase. That's going to be recorded or reflected in the machinery and equipment here and in the accumulated depreciation, which have now been adjusted. And of course, this column is taking into consideration all the adjustments we have made thus far, so you can see everything that has happened thus far in this column. Okay, next item that we're going to have. This is what we've done so far. This is the journal entries we have so far that are reflected in this column. Current journal entry. Now we're thinking about the cost of goods sold. So we thought about basically reversing the equity accounts and the equity accounts here. Now we're going to be thinking about how do I deal with the cost of goods sold and like the net income for these intercompany transactions, which we're going to be pulling from then the worksheet we put together. So we're looking at the income side of this worksheet we put together for the non-controlling interest P in total. Here's the 60,000 net income, 60,000, which we're now adjusting with regards to these adjustments that took place in the current year. So we're going to say then the cost of goods sold, we're going to credit the cost of goods sold, and we're going to get this 11,400 from our worksheet, which is the reversal of the gross profit, which is basically down and up. These top half of the worksheet, the top two adjustments. These top two adjustments are basically the prior year adjustments that we had. So that's going to add up to the 11,400, the 11,400. Then we will break them out here between the retained earnings this time. Why retained earnings? Because we didn't use the equity method here. Notice we didn't use the full equity method. We used the modified equity method. So we're debiting retained earnings, and the other side is going to that non-controlling interest. We're not breaking it out on an 80-20 split either. We're breaking it out in accordance with P's portion, which is the 6720 and the 3000. So the 6720 and the 3000 is that 9720. So we're debiting the 9720, again, not going to the investment account up top. Why? Because it wasn't included when we did the equity method. This amount wasn't included in the calculation of the equity method to include this amount here. Therefore, it's going to the retained earnings. And then we've got the non-controlling interest in NA. That's going to be this 1,680, which is going where you would expect, which would be the non-controlling interest in NA. So we record those out. So cost of goods sold being adjusted, and it's including all these adjustments over here, this column, this adjustment column. Then the retained earnings having an adjustment now as well. And then the non-controlling interest here being adjusted as well. So then, next one, we've got all the transactions we've had thus far, and then we've got the new transaction that we will be putting into place down below. Now, you might want to, there's two alternatives you can think about to do this. This yellow one might be the easier way to do just based on our worksheet. So if you look at the yellow transaction, then you're going to say, okay, we doubled the sales. The sales have to be removed as well. So the sales that happen in the current year, because they're intercompany sales. So that means there was a downstream sale in the current year and an upstream in the current year. If we add those two up, 42 and the 22 gives us to the 64,000. So sales is a credit balance account. We're going to debit it by the 64,000. Now you would think that you would credit then the cost of goods sold by that amount. And you could think about it that way, but it might be easier to look at our consolidation worksheet down here and just say, look, we took care of the top portion. We had net income, and we're basically recording this adjustment, which we already summed up here. So if we take the bottom half of this is the current year items, the 5,500 and the 9,800. If we add those two together, that's the adjustment that needs to take place for the inventory. So we're going to record the sales and we can record the inventory, and the difference between the two then will be that 48,700. If you think about the adjustment this way, you can kind of just use your table to think about it. There's the sales, the inventory is going to be tying into these two numbers, difference going to cost of goods sold. Or you can think about it this way. You can say, well, here's the sales, cost of goods sold should be related to them, which you would think would be the 15,600. If these are the sales, you would think the cost of goods sold would be the 16,500 and the 27,300. So you could record that, the difference then going to inventory. And then you need to make an adjustment for inventory and cost of goods sold for the amount that was resold down here for 2000X3 upstream transaction. So then you can make that adjustment. So I think these two are the same thing. These are two alternatives that get to the same amount. In other words, if you had the cost of goods sold, that 43,800 and the 4900, you get to that 48,700 here. So if you're memorizing just like the process, this journal entry would probably be an easier one just to memorize, right? Because you could say, that makes sense. The sales make sense to me. It makes sense that I need to utilize at least the total column of this table. We've done the top two transactions for prior year. It would make sense we would use the bottom two transactions. Where does that go? Well, I'm going to add up the 5500 plus the 9800. That needs to be the adjustment to the inventory, the 15,300, the plug then going to the cost of goods sold, the 48,700 in order to be in balance. Then we would record that out, and you'd have your adjustment over here for the sales and the inventory and so on. So and then of course you can see your check figures. These two balance out. We're all in balance here, so you can do some checks in on that.